You've been relatively bullish on this stock market, but just recently you become a bit more cautious. I'm curious what you're seeing in the market internals that suggest people should be less optimistic about where stocks go from here.
Yeah, no, thank you for having me. As you mentioned, since the April of 2020 lows, I've been bullish for two main reasons: the strong technicals in the market and the accommodative Federal Reserve. And I've discussed it several times on this network in regards to the Fed, for example. Right after the pandemic, in the 6 weeks following the pandemic, they did more treasury buying in those 6 weeks than they did in the 9 years combined from 2009 to 2018. Then they continued with that 120 billion in bond purchases and have kept interest rates at near zero. So regarding the Fed, they've provided tons of liquidity and a very equity-friendly environment. Now, regarding the technicals, they've been very strong. The 10-week moving average is sort of an area of institutional support. All the major indices and a lot of the leading growth stocks have held that level. Now, over the past 2 to 3 weeks, those two major factors have changed a little bit, with the Fed tapering their bond purchases, a little bit more of a hawkish tone, and the market pricing in rate hikes next year. And then regarding the technicals, a lot of the averages and leading stocks are starting to break down a little bit below that key average. So my conclusion is just to be defensive over the near term, not necessarily bearish, just a little bit cautious and defensive until those two factors come back again and the market shows better signs of health.
I think on the Fed, many would say that the moves from Jerome Powell and what he announced was well telegraphed, and you would sort of expect rates to move higher from here. But as you say, you're recommending investors to get more defensive. Which sectors specifically? Utilities, healthcare? I mean, these are sectors that really haven't done well so far this year, Joseph.
Yeah, that's part of why the S&P has held up very well, where the average growth stock is doing much worse than the S&P because of that sector rotation. So to your point, of the 11 major sectors in the S&P 500, healthcare, utilities, consumer staples, those have done a little bit better, which is fine. And that's helping to keep the averages muted from some of that volatility. But those, in my view, are a little bit more defensive sectors. So you can see there's been a shift to that. And also, we could have a 2018 scenario where the Fed doesn't have to raise rates. Maybe they're just hawkish, and then the market corrects, and then they can return to a dovish stance or kind of, take back some of that hawkish language. But for now, when I see too many defensive sectors leading, it's just telling me to be defensive.
And what are your thoughts on energy here, Joseph? With oil up about 0.5% right now, above 70, dollar weaker, is this a trend that continues?
Yeah, seasonally, energy does well over the summer, and we saw that big surge in energy, and we also had that mean reversion because it was down last year as demand was slower, and it's starting to pick up. I could see it stabilizing around here. I think it's, it seems to be a pretty steady sector for now.
Lastly, do you have a top pick within technology? All of these names from Apple to Facebook rallied yesterday, and I guess the question is whether it can hold.
Yeah, Apple for sure is one of the strongest mega caps out there. And I would also say the semiconductor sector as a whole within growth seems to be holding up the best. So that's the sector that within growth is doing very well.